Today's market behavior wasn't about a lack of movement, but rather a high-stakes pause as investors held their breath between a massive corporate earnings beat and a critical geopolitical reality check. It was a day of tense consolidation across the major indices. The S&P 500 drifted fractionally lower, while the Nasdaq managed to stay essentially flat, anchored by a significant move in big tech under the surface. The panic we saw last week continued to recede, with the VIX falling slightly to stay just below 25. However, the safe haven trade wasn't entirely quiet. Gold surged over 1%, and Bitcoin climbed back above $70,000. These moves suggest that while the immediate equity sell-off has paused, institutions are still aggressively positioning for a regime of higher volatility. Two conflicting stories define the day. On one side, we had a major validation signal from the software sector. Oracle reported a massive earnings beat, with AI-driven contracts sending their cloud backlog up over 300%. This gave the market permission to decouple AI infrastructure from the broader macro mess. On the other side, the geopolitical peace optimism from yesterday hit a wall. The Iranian Revolutionary Guard issued a blunt reminder that not external powers will determine when the conflict ends. This was immediately followed by reports of fresh drone attacks on regional infrastructure. This effectively shattered the hope for a quick resolution and pushed crude oil back up nearly 3%. Settling near $88 a barrel, institutional money is currently undergoing a quality bifurcation. We are seeing capital flow into performance winners like Oracle and Amazon, companies that investors believe can earn their way through an energy shock. Meanwhile, we're seeing a persistent abandonment of the energy sector. This might seem counterintuitive given the rise in oil prices, but it's actually a positioning flush after the manic price swings we've seen, moving from $120 down to $83 and back up again. The sector has become too volatile for many institutional risk mandates. Money is seeking the relative digital liquidity of tech and even Bitcoin as a hedge against fiat instability. In the Middle East, a risk that isn't getting enough attention right now is the refinery maintenance bottleneck. While the world is focused on the blockade in the Strait of Hormuz, we are entering the seasonal transition where U.S. refineries switch to summer blend gasoline. With Middle Eastern supply already stressed, our domestic infrastructure is running at its absolute limit. If we see even a minor technical failure at a major U.S. refinery during this window, gas prices could spike significantly. Regardless of what happens overseas, the real question may be whether markets are underestimating how thin our domestic energy cushion really is. I'd be interested to hear how you're interpreting this. Is the market too focused on the war and missing the fragility in our own backyard? Let me know your thoughts in the comments. The broader signal today is one of data dependency. The market has moved from a state of blind panic to one of calculated uncertainty. We are no longer pricing in an immediate global collapse, but we aren't pricing in a soft landing either. Investors are demanding physical proof of de-escalation rather than just headlines. And they are waiting for the hard data to tell them what the Fed's next move will be. Everything now hinges on the next 48 hours. Tomorrow morning, we get the February CPI report. This is the ultimate confidence breaker. If inflation comes in hot, it traps the Fed into keeping rates high even as the economy slows. We also have Adobe reporting earnings on Thursday. While Oracle proved that AI infrastructure is selling, Adobe will show us if AI monetization at the software level is actually happening. These two data points will determine whether today's tech resilience is a durable pivot or just a temporary place to hide. The broader takeaway from today's market reaction is that we are in a pause, not a pivot. The market is waiting for evidence on inflation, on earnings, and on actual oil delivery. What this suggests for investors is to maintain core positions but avoid adding leverage before the CPI data clears the air. But markets rarely move on a single narrative, so I'd be interested to hear how you interpret today's signals. If you enjoy this type of calm, analytical breakdown of global markets, consider subscribing. I publish regular briefings focused on the deeper forces shaping market behavior. Thank you for spending a few minutes here today. I appreciate you being part of the channel.